In the fall of 2008, the global financial system fractured. In a matter of days, the world's largest credit market seized, and trillions of dollars in market value vanished from the global economy. This data maps the scale of the resulting intervention. To prevent a total collapse of the banking sector, the U.S. Treasury initiated a $700 billion bailout, alongside a $150 billion rescue of insurance giant AIG. While the 2008 crash was severe, its internal mechanics follow a recurring pattern found in almost all modern economies. This wave graph illustrates how economic activity moves through predictable stages over time. In a free market system, real gross domestic product, the total value of all goods and services produced, moves in rhythmic fluctuations. This sequence of growth and decline is formally known as the business cycle. The 1930 Great Depression and the 2008 financial crisis serve as the primary case studies for understanding how these cycles can reach extreme levels of instability. By analyzing the data from these historical events, we can identify the specific variables that drive economic expansion and contraction, creating a map to navigate the current state of the global market. We begin with a theoretical baseline. This diagonal line represents a steady growth trend, assuming an economy operates with constant efficiency. Actual economic activity pulls away from this trend line. This rising curve represents the expansion phase, where growth accelerates beyond the baseline. During an expansion, national output rises, businesses hire more labor to meet production needs, and consumer aggregate demand increases across multiple sectors. This growth is fueled by the money supply. When central banks keep interest rates low, the influx of cheap credit allows both businesses and consumers to take on debt, which acts as a direct catalyst for further expansion. Eventually, the economy reaches a point where resources are fully utilized and prices hit their maximum level. This is the peak. At this stage, actual demand begins to stagnate as the cost of living outpaces wage growth. We saw this in the 2006 U.S. housing market. Property values rose significantly while median incomes remained flat, creating a pricing gap supported almost exclusively by subprime debt. Because a peak is built on overinvestment and debt, rather than sustainable value, a downward correction follows once the market can no longer support the inflated prices. When growth stops, the curve bends downward, entering the contraction phase. At this point, the economy begins to shrink relative to the trend line. This textbook excerpt identifies the trigger for a recession, a sudden drop in investment. Producers, realizing they have overextended their capacity, cancel equipment orders and halt new projects, leading to a decline in employment and income. In 2008, this contraction was driven by the collapse of the housing bubble. As mortgage defaults climbed, bank balance sheets were paralyzed by toxic debt, leading to the bankruptcy of major institutions like Lehman Brothers. As production plummets, the economy reaches the trough. According to this text, the trough is characterized by negative growth rates and extremely low levels of economic activity. If an economy remains at this lowest turning point for an extended period, the recession is classified as a depression. The 1930 Great Depression remains the primary historical benchmark for a prolonged economic trough. These events are rarely localized. This mind map traces the contagion effect. The 1929 stock market crash in the U.S. quickly spread through trade and debt channels to Great Britain, Germany, and the rest of the industrialized world. Economist John Maynard Keynes observed this dynamic, arguing that sudden drops in aggregate demand are the primary drivers of these deep economic downswings. External shocks can also force an economy into contraction, such as the sudden impact of a war, a natural disaster, or a global pandemic. Recessions perform a structural function within the cycle. By liquidating non-productive debt and excess capacity, they force a recalibration of the global economic baseline. To manage these cycles, economists use specific metrics to identify a contraction before it is felt by the general public. They monitor a dashboard of economic indicators that signal where an economy sits on the GDP curve in real time. This table defines leading indicators. These are measurable factors that change direction before the overall economy starts to follow a new trend. Stock prices are a primary leading indicator. Because equity markets are based on future expectations, early shifts in stock prices or new orders for capital goods often signal a change in the business cycle months in advance. In contrast, the lower section of this table lists lagging indicators. These metrics only shift after the historical economic performance has already changed. The unemployment rate is a lagging indicator. Because firms wait as long as possible before laying off staff or adjusting wages, a spike in joblessness typically confirms that a recession has been underway for several months. When mapped together, these indicators move asynchronously. Leading data shifts first, the GDP wave follows, and lagging data trails behind to confirm the cycle's new phase. Institutions like the Federal Reserve monitor these indicators to adjust macroeconomic policy, raising or lowering interest rates to either slow an overheating expansion or stimulate growth during a contraction. While policy can mitigate the damage, correctly reading these signals provides the lead time necessary to adjust business and investment strategies. Once the market clears non-productive debt, the economy enters the final phase, recovery. As noted in this text, recovery begins when low prices stimulate new demand. Producers develop a positive attitude toward investment and begin replacing depreciated equipment. Innovation can accelerate this phase. For example, the boom in mobile technology created new capital demand and hiring cycles, shortening the path back to steady growth. The recovery phase pulls the GDP curve back up to the steady growth trendline, completing one full cycle and beginning the next. For business leaders, this macroeconomic theory provides a framework for strategic decision-making. Identifying an expansion phase suggests a posture of growth, indicating the time to increase investment and capture market share while demand is high. Conversely, recognizing the signals of a contraction suggests a shift to capital preservation and defensive strategies to maintain stability through the trough. Economic crashes are structural features of the global market. They represent the system's mechanical process of correcting for overextension and debt. Understanding the interplay of demand, investment, and policy shifts provides the data points needed to navigate the next inevitable cycle.